Hi, and a huge welcome back to the channel today. My name is Neil McCoy Ward, and we are going to be talking about the housing market, a topic I haven't covered on the channel for about a year now, but due to all the feedback and the comments asking when these videos are coming back, I had no idea that for some of you, these were your favorite videos. So I've decided to bring it back in the exact same format that I used to do the monthly updates. So let's get into it now then. So we're going to begin then here on the FRED website. This is the Federal Reserve of the United States website here. Anybody can go on here and look at this data. And we're going to look at median sales prices of houses sold in the United States. Now this data goes right back to 1963, but really we want to focus here from the last recession up to where we are right now. And I just want to bring your attention to this, what happened during the last housing recession, where prices decreased fairly dramatically across the country. Now, let's bring this a little closer then and see where we are here. So these gray shaded areas mean recession. So in 2020, we went into recession for a short period of time, just one quarter, so approximately 3 months. And since we actually came out of that very short recession, prices went from an average of $322,000 and they have just skyrocketed right up to over $400,000 as of Q3. So that is the third quarter of last year, 2021. This is where the data goes up to currently, showing an average house price of over $400,000, which is absolutely staggering. So let's go over to Zillow now then, which is another data center that I use for my USA data. And you can see they actually put the average home price at $316,000. So slightly different to the FRED, although that was median sales prices of houses sold. And Zillow has it at 19.3% as a 1 year change, which is not far off. It was actually about 18% by the time we had all the data in. And they're actually forecasting, which is surprising actually, a 14.3% 1 year increase over the next year. Personally, I don't think that is accurate. If we look at a lot of commentators on the housing market at the moment, and you look at a lot of the other indexes, and there are dozens, I would say the average that most experts are forecasting is anywhere from 3 to 7% for this year. Zillow is the only one that is way out at 14% increase. Again, on the FRED website again then, so before I showed you median sales prices, now we're going to look at all transactions. So this is the house price index for the United States. And again, you can see, I want to show you this trajectory actually, because it is quite interesting. So this was the trajectory from the 1990s through to when we went into the housing crash that began sort of 2007, 2008 period and ran right down to about 2012. This was the last recession that we went through. Now I want you to notice how the trajectory went up fairly smooth and then it started to accelerate here before it started to plateau and then form this bell curve, which I often talk about in the housing market. We see a fairly normal increase year on year, maybe 4 or 5%, pretty typical. But then sometimes it goes into this sharp increase before forming a bell curve or a plateau before going into a decline. Now, I want you to notice then where we were in 2012 coming out of this. Again, we saw this steady increase, which has been going for a long period of time. And then 2020 just took off like a rocket. And it's now really just shot up in terms of actual transactions here. Now, does this mean that we are going to see a repeat of the 2008-2012 crash? Well, not necessarily, but it does show some similarities between the two periods there. The main difference that we're going through right now is we have incredibly low inventory, we have incredibly low interest rates, and we have a high demand on housing. But I'm actually expecting inventory to improve later this year. So from about Q2, so the summertime of 2022, I'm expecting housing inventory to increase a little bit, to improve a lot more than it is right now. Housing inventory, because it is so low, is really pulling up or pushing up the prices right across the country. And when you combine this with incredibly low interest rates as they are right now, or more specifically mortgage interest rates, this again helps to pull up prices. However, remember what I said a year ago now. It doesn't matter how long this goes on for, you always have a cap in any housing market, and that is affordability. So it doesn't matter if this goes on for another year, another 2 years, eventually people will be priced out in terms of affordability, and it will go through waves. So it will begin with sort of apartments and the smaller properties, eventually going through to the very expensive $1 million or more properties. Hi, if you're getting value from this video so far, could you do me a quick favor? Just click the like button for me. Why not subscribe if you're not already? But more importantly, I'd love to get some feedback from you. I'd love to read your comments today. Let me know if you'd like more housing market videos back on this channel again. Thank you. And this is just an article that I've just pulled up. Experts split on sales impact from potential affordability woes versus inventory gains. This is a good article. You can find it on Zillow. It was released on January the 11th. Really interesting article. I recommend you read it. Housing experts are evenly divided on whether sales will rise or fall in 2022. And it's very interesting if you look at the statistics here, the percentages. 41% of people who were asked the question expect sales will grow. 41%, again the exact same number, expect them to fall, and 18% believe they will plateau. Very, very interesting. So out of all of these people that were interviewed and asked about this, it was split down the middle. So there really wasn't any general consensus either way. And again, if we look at this statement here, panelists who foresee lower sales in 2022 point to financial strains on buyers as the main driving factors, which is exactly what I just mentioned here. Eventually, people will be priced out. The affordability will be priced out, especially when we see rising mortgage interest rates this year, which I believe we will see. If we see a 0.25% increase 3 to 4 times this year in 2022, that is a 1% increase minimum being added on to mortgage interest rates. Now, it's not an exact science. It doesn't mean it will exactly happen like that, but that's definitely a potential. So for those of you who have already got your mortgage, you've got a 20, 30-year fixed rate, predominantly in the USA, because you can't get long-term fixed rates like that in most countries. You are very blessed in the USA that you can do this. I would say fantastic, well done if you've got these very long fixed rates at 2-3%. But what I think is going to happen this year is interest rates will definitely increase. I'm almost certain of it. Interest rates will have to increase somewhat this year. Might not be huge gains, but it will be some very small incremental gains. We could even see 3-4 very, very small 0.25% increases this year in interest rates. Now, why is that important? What would that do? Well, new people who want to come into the market, so maybe millennials or the next generation down coming into the market for the first time, their affordability will be slightly less than those people who bought during 2020, 2021. Why? Because the rates during these 2-year periods were exceptionally low. People fixed 20, 30 years, whereas people coming in now will have to pay slightly more, meaning their affordability will be slightly less. So this may affect house prices as we move forward throughout later in the year. Now, the next thing I wanted to show you here, again on the Federal Reserve data, is household debt service payments as a percentage of people's disposable income. A very, very important and useful chart. Now, if we look back to the last recession where it peaked at around 13%. So that means of all of your income, of every $100 that you bring in, around $13 went towards household debt servicing of payments. Now, then what actually happened throughout the recession was people realized what was going on and that they needed to live a little bit more below their means. They brought this down and it continued to go down right through the recession. and then it plateaued for a period as more good times came along. But then let's just zoom in on this a little bit. So let's see what happened then as we moved in closer to the last short-term recession. So this is when the crisis hit, which was around December of 2019. The lockdowns began in March of 2020. And then what we saw was household debt increase. Now, that isn't the typical line from the media and the government. They say that household debt decreased. So what actually happened here, and why do we see this V shape? Why is it so conflicted, all the information out there? Well, I can only give you my opinion on what I think happened here. And again, whenever you go into a tough time, people start to pay down debt, they start to reduce their outgoing payments. But then we can see here it peaked. Personally, I think this is because a lot of people started to refinance. So they came out of the recession here at this sort of time, and they started to refinance, take advantage of these low rate, long-term fixed mortgages. And they didn't just refinance for the same amount. And again, I have a lot of clients. I asked them, did you just refinance for the same amount? And I would say almost none of them said yes. What they actually did was they took on more debt because the house values went up, so they were able to take on more debt. So what people use this additional money for is anyone's guess. It's very varied. Some people simply go out and blow it and buy liabilities. Other people may invest it, use it for investments, do something with it, especially when it's so low as 3% or even lower on some of these fixed rates. Some people know that are quite well versed in the stock market that they could get a lot more, or with other investments. So that may have been part of it as well. But then we saw this dip again into this V shape. So if we actually look at this on a longer scale here, the household debt service payments as a percentage of disposable income was a lot higher back in 2007, prior to the last housing market crash, than it is today. So we're about 9% as of today. It was about 10% just before this last recession. So it is still a lot lower than this 13%. However, I think that if interest rates do go up significantly over the next 2, 3, 4 years, which really they have to, although if they do try and raise interest rates, you may see the Federal Reserve going back to more asset purchases, quantitative easing to offset the increase in interest rates. They really are in a catch-22 situation, but I think they are going to try and raise rates perhaps by 1% by the end of 2022. Now, what would this do to this chart here then? If you increase rates, initially not a lot would happen, not a lot would change, but as more buyers come into the market, as people's fixed terms may end and they have to refinance at a slightly higher rate, you will see this 9% increase slightly. It will, no problem at all, go to 10%. And over time, if rates do go up significantly, which I just can't see how they're going to do it too much, because it would basically cripple the government in terms of their debt payments. In fact, let's move on to that now so I can show you what I'm talking about. So this is the US debt clock. And you can see last time we covered this, the debt was nowhere near what it is right now. It's almost $30 trillion. I mean, that is just unheard of. $30 trillion. And you can see it just keeps going up and up and up. It never stops. So the debt per citizen is $90,000 almost per taxpayer. So if you are a taxpayer in the USA, your share of that debt, which you have no choice over whether you want to have that share or not, is now $238,000, with a US federal spending at 6.8 trillion, almost 6.9 trillion, and a deficit, so a budget deficit of 2.8 trillion. Now, if we look at the federal debt to GDP ratio, which is this part here, this is what's very, very worrying. 1960s, 53%. 1980s, they brought that down to 35%. 2000 was 60%. Now it is 127%. It's very worrying to see these sort of numbers. Now, if you look at the US federal tax revenue coming in, that's 4 trillion. And look at the debt here, almost 30 trillion. It's pretty crazy. Now, this is the other thing I wanted to show you. So this is the, again, on the Debt Clock website, new housing starts annual rate. So 2007, 1.7 million, and then we had a somewhat of a drop, especially through the recession here. We had a significant drop of new housing starts. And then they increased once we came out of this. 2015, we saw a million hit again. Now, if we look here, this is what I was talking about earlier. Let me zoom in on this a bit. So 2018, 1.2, 2019, 1.3. Now 2020, again 1.3 as well. So this is where we're in recessionary period here, the very short recession. But 2021 has seen a significant increase to over 1.5 million new starts. 2022, we've seen more still, so 1.6 million. Now, why is this important? Well, because what do we mention? One of the biggest issues right now is inventory. We have very low inventory. But with a lot more housing starts coming onto the market, this should help to ease the inventory pressure. So it will make it a lot better as a marketplace for buyers as we go later into 2022. Now, the next chart I want to show you is assets, so securities held outright, mortgage-backed securities by the Federal Reserve. So this is known as MBS. So if you ever see the abbreviation MBS, this is what they are talking about. Now, this got me in some hot water, if you remember, a year or so ago, because I exposed this. It was a very popular video. I think it had 500,000 views or so. I exposed just how much mortgage debt the Federal Reserve actually owned. And I think a lot of people were quite shocked, because prior to 2008, the Federal Reserve didn't get involved in mortgages. They didn't go out buying mortgages with money that they created out of thin air, which is in fact what they do. But if we come forward a bit then, this is what happened during the last recession, housing market recession. The Federal Reserve went on a spending spree. They bought more than $1 trillion of mortgages. And then they tried to just ease off a little bit, but they found that it just wasn't working. So they had to go back into more of an asset buying spree. So they went out and they bought one of the safest assets you can buy, which is houses or mortgages more specifically. And then once they got into 2014 period, you saw this plateau start to happen here right through to 2018. And then they tried to ease off, which is what they're going to try and do this year in terms of quantitative easing, known as QE. They're going to try and ease off on the asset purchases in terms of mortgage-backed securities. Now, if you notice what happened as we went into the pandemic here, then let's just zoom in a little bit more. They went back onto this asset buying spree all over again. And you can see where we got up to almost $2.6 trillion worth of mortgages. That is a lot of mortgages. Now, what they're going to try and do then this year, although whether they'll be able to do it is another matter, is they're going to try to increase interest rates. Now, we know it's going to be at least 0.75%. I think they may even try and do 1%. So they might push for a fourth rate rise. At the same time, they're going to try and taper back the quantitative easing. So that means taper back the asset purchases like MBS that we're showing you here. Now, if they do that, this could have knock-on effects to the housing market via the stock market. So we're going to have to sort of watch this and track it over the next few months, but I'll keep you up to date on all of this. I want to move on now then to the Redfin data center. So this is redfin.com, and this is very, very useful data that I've always used. So let's have a look at it then. So this is the weekly housing market data, and what I've pulled up on the key here is 2019, 20, and 21. I haven't pulled up anything for 2022 because there really isn't much data yet. So this is new listings in all metro areas. Now, I don't find this to be the most useful chart. I prefer looking at year on year. So let's move down to this chart here and let's look at this year on year then, so I can show you what we're looking at. Let me just get that in position. Okay, great. So let's look at 2019 first of all then, which is this blue line here. And you can see new listings were about normal. There wasn't really much that was notable throughout 2019. It was a fairly standard year in terms of the housing market. But then as we get into 2020 here, until we get into this period here. So as we get into February, you got to remember, or February, March time, you have to remember that this is when lockdown started. This is when the whole COVID issue started. Around this period that it started to get a little more serious, being in the news every day, in the media every day. And this is where we started to see some differences. And then this is really where it kicked in, was here. So March, from the beginning right through to the end of March, we saw this huge dip, which is not normal. So we saw new listings drop by 40% during this period. And then they sort of picked back up here and they normalized around summer. And then again, we saw this major deviation from the normal trend right through to the end of the year. And even more bizarrely then, as we went into 2021, which is this orange line here then, we started to see a normalized housing market at the beginning of the year, so the January period, before it just spiked off. So it did an inversion actually from 2020, where we actually saw a 60% increase in listings year over year, versus last year was a minus 40% from 2019. So if you look here, you notice, and you use this as your sort of trend line here, 2019, 2021 and 2020 were very different periods. So if we move down then to the rental aspect here, so you can see this is 2019, so before the pandemic kicked in, you can see that it was fairly stable across the country in terms of rent prices. And then if we look at 2021, we have this little uptick in terms of mortgage rates. Now, again, I personally think this is because people refinanced and they took on more household debt in the form of mortgages. And then if we look at the average rent, again, it just took off in March of 2021 and skyrocketed up to $1,836 by August of 2021. Now, we don't have the exact data then for what rents are now, but we do have this article here, and this talks about rents surging from 7% from October to November. And payments jumped 21% annually, making the steepest monthly and yearly increases in the last 2 years. So we did see some huge increases over last year, so around 20% from the same time last year. And again, they're pulling this data from Redfin here. So I wouldn't be surprised at all if this is closer to $2,000 as at now in January of 2022. Some really steep increases. So it raises the question, is it better to actually buy and get a mortgage, or is it better to rent? Well, the numbers here say that you could be saving potentially $800 per month by actually getting a mortgage and purchasing a home. Again, let's bring up the data that I became quite known for in the housing market, and this was migration data, way before migration data was really a big thing. Now, I want to show you Boise, Idaho, which, if you remember a couple of years ago, that I said that Boise would be one of the biggest gaining in terms of prices throughout the whole of the USA. You can go back and watch the old videos from a couple of years ago and you'll see all this data that I talked about, and that did actually come to pass now. Boise has seen huge gains over the last couple of years, just unparalleled gains. And where do people move from then? Los Angeles, a huge number of people moved from Los Angeles to Boise. Bay Area, Seattle, Portland, Washington, D.C., Sacramento, San Diego, and then we had a few people moving from Phoenix, Vegas, and Denver. But Boise was an absolutely huge area. Now, let's take this off and let's go to all. And you can see where we're seeing a lot of trends. It was exactly as we talked about last year. A lot of people moving from Denver to Chicago. We're seeing a lot of people moving from San Jose, so the San Jose area, and they were moving up to Portland or Seattle. We saw a lot of people from LA moving to Las Vegas, moving out to Phoenix, moving up to Seattle as well. And then here, a huge number of people moving out of Washington, absolutely staggering numbers moving out there. New York down to Miami, a lot of people migrating. Boston to Portland, ME. So we are still seeing a lot of migration. I definitely think the migration has slowed somewhat now then. And again, if we just recap on that, a lot of the migration was from the big cities where the lockdowns, a lot of people were fearful, they wanted to get out because back then we didn't know how deadly, this virus was going to be. So a lot of people, they got out of the big cities straight away, the people who just didn't want to be anywhere near large groups of people, and they moved out to more rural areas or moved out to the suburbs. So we saw this huge amount of mass migration for the first year, went into the second year as well, and even this year, it looks like we're still going to be seeing some more migration as we go into 2022. I don't think it's going to be as crazy though as it has been the last couple of years. It seems like we're actually winding out of this situation we've been in for the last couple of years now. It doesn't seem to be in the media 10 stories a day as it was over the last couple of years. So we'll have to just track and monitor this and see how the migration goes. But I definitely do think we're going to see more migration, especially some of the bigger cities that are not what they once were. Let's just say that. I think you know what I'm referring to there. Some of the big cities, a lot of the benefits have gone from being in the big cities, so people are starting to migrate out. And I do just want to show you one last data point here then. This is from Altos Research, excellent piece of research data here. And this really is Boise. So I want to show you Boise now, Idaho. It's still a strong seller's market. It's not as strong as it used to be where it was almost 100. It was in the high 90s at one stage, Boise was. It's definitely started to drop now in terms of just the crazed frenzy in prices. So let's look at the median list price. So if we go back to 2019, January, the median list price on a 7-day average was about $408,000. Now, as we moved into January of 2020, where all of this started to begin, we saw a 7-day average of about $428,000. And then this is where it went crazy. So let's fast forward a year then to January of 2021, and we'd gone up to $570,000 on a 7-day average. And now where we are as of right now, we're over $600,000 now, which is just insane. I want to show you Los Angeles now. They're another one we talked about a lot. It is still a seller's market, a strong seller's market, but not quite as strong as it used to be at 52. Inventory levels, if you notice here, what's pushing up prices, it's low inventories. 673, whereas before it was almost 3 times that if we go back to 2019. New York then, let's take a look at New York. Last month, now this is very interesting about the data around New York. So New York really fell into a buyer's market in one period, as well as a couple of other major cities. But now you can see that the buyers are actually coming back to New York and they're starting to take advantage of some of the prices available. So you see it's a lot more of a seller's market if you notice this chart here than it was last month. Now let's look at the median list price. And again, you can see it is all over the place right now in New York, median list price, but it has been increasing. And if we look at inventory here, why are the prices increasing so much? Well, we have historically low inventory here. Okay, last one I want to show you then is Las Vegas. Still a very strong seller's market because a lot of people are moving still from Los Angeles, etc., to Las Vegas to take advantage of better pricing, more space, etc. So again, we look at the median list price. What are we going to see is increasing prices as a result of very low inventory. So I hope that was useful today in terms of the housing market analysis. Please click the like button, subscribe if you haven't already, maybe share this video with a friend or family member. But more importantly, please leave me a comment below. Let me know what you thought of the video. Would you like me to make more housing market analysis videos for you? I'd love to get your feedback on it. But apart from that, take care, God bless, and I will see you next time.